We are continuing with our double entry for the 10 transactions. Fortunately for us, we did 4, or we have done 4 so far. We are continuing today. It is my prayer that we can finish all 10 today, and we begin to solve illustrations where we'll be debiting and crediting account. Okay. So the 5th point is acquisition of loan. Acquisition of loan. Just as a recap, we've done the investment by owner, purchase of goods, sale of goods, and purchase of an asset or acquisition of an asset. And I think we did the acquisition of loan. Yes. So we did the 5th one. Great. So the 6th one is settlement of a liability. And we all know a liability, right? A liability is a debt. So if you are settling a debt or a liability, what entries do you pass? That's what we want to look at. So who is doing the reading for me today? Who is doing the reading for me today? Settlement of a liability. Yes. One of you should do the reading, please. Professor Gabriel Jan, would you do us the honor by reading for us? Prof. Jan. Okay. Prof. Araba Yeboah, I think yes. Araba Yeboah, please do us the honor.
Settlement of a liability. Settling a liability, loan or creditor, decreases the liability and the means, that is the asset, cash or bank, that is used to settle that liability also decreases. Therefore, the double entries will be debit the liability credit and asset, cash or bank.
Okay.
Example A. Paid a creditor. Abakwa by check 3,000 Ghana cedis on 20th January 2022. Asset.
Okay, so Araba, thank you. That was a great reading. Thank you very much. So settling a liability. So what is a liability? A liability is a debt, right? So if the business wants to pay off the debt, that is in the realm of settling the liability. So I indicated that if you are settling a liability, then that liability is going to decrease, right? If you owe somebody or you are indebted to somebody and you are settling, the indebtedness would reduce or decrease. So liability would what? Decrease. So you normally open the liability account and then you debit, because when liabilities are decreasing, we debit, right? So if the liability is a loan or is a creditor, you open the loan or creditor's account and you debit. Okay. Now, you can only make settlement with cash or check. In some cases, you can use another asset. Okay, you can use a building to settle a debt, right? But most of the times it is cash or check. But don't be overwhelmed when you see that the business use the building to settle a liability. For companies, they can sometimes use their shares to settle a liability. So instead of paying cash, they will tell the person to become a shareholder. So they will allot some shares to the magnitude of the debt. Okay, so those things are there. But the basic settlement of a liability will be in the form of using cash or check. Okay. So if you are using cash or check to settle or to pay for a debt, technically that cash will reduce or the money in the bank account will reduce. And cash and bank are assets, right? So asset, cash or bank would decrease, and when assets decrease, what do? We credit them. So in this transaction, the effect will be decrease in a liability and decrease in an asset. The liability will be a loan or a creditor or any other liability, and the asset will be cash bank. And as I hinted, it could be a vehicle or a land, right? Okay. So the first example was paid a creditor, Abakwa, by check. So we are paying a creditor. Abakwa was somebody we owe, a liability, a creditor, right? So since we are paying, the debt will reduce. You see that here too, you can use the personal account because Abakwa is a person, right? And Abakwa is receiving, because if you are paying Abakwa, it means Abakwa is receiving money. So you debit the receiver. That's if you go the personal account way. But if you go the element way, Abakwa is a liability. And if a liability is decreasing, we debit it. That's why we debit Abakwa's account and credit the bank, because bank asset will be decreasing. I hope that is well noted. Please, any questions on that settlement? No question. 7, payment of expense. Payment of expense. Now, it's important for us to understand what expenses are. Okay. Let me do this for us so that my professors will appreciate. You see, in accounting, all that we are doing sometimes is so confusing, but technically, in accounting is either you are making payment or you are receiving. It's either you are paying something or you are receiving. So it's either you are gaining or you are losing. Let me use receipts. Payment, receipt. So when you look at the payment, you can pay for a building, you can pay for rent, you can pay for electricity bill. But if you look at the payment, you see that some of them behave in a certain way and others too in another way, right? What do I mean? For example, if I say paid for a land and you compare it to pay for rent, if you look at these two transactions, they are all payments, right? But if you look at it, the land has some form of long-term benefits compared to the rent, because if you pay for rent for 1 year, within 1 year, the rent expires. You don't enjoy the building again. But if you buy a land, it's going to be there for how many years? Only God knows, right? So, though they are all payments, one has something that is of value and is going to last in the business longer than the other. And so that leads us into categorizing them into assets and expenses. So in essence, they are all payment, but by their nature, one is classified as an asset and the other is classified as what? An expense. Okay, so we need to appreciate the meaning of expense so that you get the point that I just made. So let's look at what expenses are. And I will employ, today I've not seen Emmanuel Nati, are you here? Okay, so who is going to do the reading? I think Joshua Boating. Joshua Boating. Please, can you do the reading for us? Expenses. Okay, if Josh is not available,
payment of expense.
Great, go ahead.
Payment of expenses. Expenses are costs incurred in running a business to generate profit. Technically, it refers to decrease in the financial resource of a business associated with sale of goods and services to customers. Expenses decreases the profits of a business, which ultimately decreases the capital of owner's equity. Examples of expenses to businesses are rent, wages, salaries, maintenance, discount allowed, and bad debt, electricity, insurance, etc. Paying expenses reduce assets cash or check, and decreases capital. The double entries are debit expenses, expense account, credit, cash, or bank. Even though expenses decrease capital in accounting equation, an expense account should be opened to record the expense by debiting the expense account.
Okay, thank you very much. Thank you very much. In fact, some very important points here we have to note. And I am always quick to say that some teachers do not speak about this. So when students are given transactions to tell the effects of transactions on the accounting equation, they normally struggle when there is payment of expense. So please listen carefully. Because you remember from the beginning that we said the elements of accounting are 5, right? But in the accounting equation, you only see 3, which is asset, liability, and what? Capital. So definitely when the question asks you to show the effect on the accounting equation, you can only speak about asset, capital, and liability, right? So what if the transaction is an expense? Now, I want you to understand it this way. How do we determine profits? Profit is determined by your income minus your expenses. I think we all agree to this fact. If you want to know your profit, then you look at the income, the revenue that you receive, and you subtract your expenses. Now, profit also goes ahead to affect capital. Why is it so? Because if a business is making profit, then in a way, their capital is also what? Increasing. That is why when our mothers in the market are making losses, their capital reduces to the level where they cannot even operate the business again because the capital, they normally say in peace, maybe a trainer a day, I didn't think a trainer because she's making losses. So when a business is making losses, in the long run, the capital would what? Decrease. Now, if you look at the relationship between expenses and profits, expenses reduce profits. So if expenses are reducing profits, that makes capital, increase, then technically expenses decrease capital. I want you to get that relationship before we move on. First of all, if you want to get your profit, it's your income minus expense, right? So it means that, as you see here, minus. So it means expenses affect profits negatively, or it decreases profit. If your expenses are plenty, your profit will be lower. And if your profit is lower, it means your capital will also be decreasing. So if we are looking at the relationship between expense and capital, then we can say expenses decrease capital. Please let me hold on for you to assimilate that before we move on. Please, do you understand the point? Okay, let me ask few people to explain it in their own terms. So, Prof. Fidel, how do you understand the points that I just made about expense, profit, and capital? Or maybe I should try another person. Okay, let me hear from Nicole. Prof. Nicole.
So please, you said the lower the expense, the higher the profit, and the higher the expense, the lower the profit.
So what direct relationship does do expenses have on capital?
Expenses can either decrease or increase capital.
Why did you bring either increase or decrease? I want one effect because you should have one effect.
So please, it decreases capital.
Exactly so, right? And I want you to build your understanding from daily life experience. Those of us who have parents who are running businesses, okay, expenses are normally seen as, costs, right? Costs. You are incurring costs. The more you incur costs, your capital would decrease. In fact, will dwindle. Okay. So if your parents come and say, may bokadodo, it means their expenses are going up. May bokadodo. The next thing you hear is my capital is off. My gateway has shares. I don't know if these are right statements I should use, but I hope you understand. So the more you incur expenses, the more your capital decreases. So expenses decrease capital. The opposite is true for income. Income would rather increase it because the more you are making income. So when your parents come home and they are happy, today they have sold or my income is going up. What it means is that their capital will also be increasing, right? So if you are looking at the effects of expenses on the elements of accounting or the accounting equation, then we say that expenses decrease capital. So anytime you make payment for expense, capital decreases. Now, based on the principle we discussed, if capital decreases, what we do? We debit. And when it increases, we credit. So if you pay expenses and they decrease capital, you would have to debit. But what account would you debit? You debit the expense account. You don't debit capital, even though the decrease is in the capital account. You open an expense account and what? Debit. When we move further, you would appreciate that these expenses and income will be matched against each other to get the profit, which will now be added to the capital. Okay, great. Now we pay expenses with money, so either cash or what? Bank. So if cash or bank is being used, then it will decrease, right? So we credit. Now, as we learn these transactions, you should also be building summaries, especially for transactions that have cash and bank. By now, you should be comfortable that if we are paying cash or check, then cash account, bank account should be credited. If we are receiving, then they should be debited. So you should also build those summaries along. Okay. There's no one sure way of applying the principle. You have to look at it from all the angles that I've exposed you to so that you can reliably record the transactions. Okay. So that explains why when you pay an expense like rent, you open the expense rent account, you debit it, and then you credit cash if it was paid with cash, or you debit bank if it was with check. However, there are some expenses too that are incurred, we don't pay them, right? Like you have stayed in the room for 3 months, you haven't paid rent. So at that point, you would still debit your this time you have to create a supplier's account because you haven't paid, so you owe the person, right? So you open your rent account and the creditors account. So we have creditors for expenses too, right? But most of the times you don't see that in your illustrations. But I'm just alerting you so that in case you come across it like that. Okay. So I think that settles it for the expense. The opposite is receipt of income, right? When you receive income, your capital would increase. And the income that you are receiving may be in the form of cash or check. So the asset cash or bank would also increase. So here there will be increase in capital and increase in asset. I think from this analysis, you are now okay that income would increase capital. So anytime you see received commission, received interest, okay, then you open your income account, you credit it because then capital will be increasing. If capital is increasing, you credit that account, which is the income account. Then since the income will be coming in the form of cash or check, you debit your cash or check account, right? So that one too is very simple. Then we are gradually getting to the end. We have number 9, return outwards. And I want my professors to appreciate this return outwards returning because they came up with the tables. Okay, Nicole has a question. Let's hear.
Sir, please, the payment of expenses.
Mm-hmm.
Can you please go back?
Okay. You've seen some error there and some typo error. Okay. Payment.
I just want to understand something.
Okay. I'm at your
Sir.
service, Prof. Yes.
No. Sir, can you also say that the expense?
Mm-hmm.
Yeah. Okay, over here. Paid motor expenses by cash.
Mm-hmm.
You say that the asset decreases and then expense increases.
So when you say that,
No,
you see,
expense increases.
Expenses decreases. Oh, sorry, expenses decrease.
Yeah.
No, your expenses will not decrease. So because you are buying. So let's do this scenario. Let's use the rent since it's more relatable. Then maybe we'll come to the motor expense. So let's say right now I'm not renting anybody's room, right? So I'm not incurring any rent expense. But immediately I go for somebody's building and I pay rent. What has happened to me? I'm incurring rent. So my rent expense will increase from 0 to the amount that I'm paying right now, right? Does it make sense in that regard?
Sir, please, can you elaborate?
So let's use electricity, right? If you don't have light in your home, would you be paying electricity bill as expense? No, right?
Yes.
So at that point, we say your electricity bill expense or your electricity expense is 0. Now, immediately you get light and you go and pay for electricity bill. Can you still say that your electricity expense is 0? No. It will increase from 0 to where? Maybe 100 cedis, right? So anytime you make payment for expense, the expense increase. The expense increase, but that increase has a net effect on capital by way of decreasing capital. So don't confuse the decrease on capital with the increase in expense. Okay, so I'm taking the point again. I have a motor vehicle, right? I have a motor vehicle. One of the expense on motor vehicle is paying for your insurance. Okay. So if you haven't paid for the insurance and they ask you, what is your insurance expense on your motor? The answer will be 0. At that point, you haven't paid anything, 0. But immediately you pay, when they ask you, let's say you pay 300. When they ask you, what is your motor insurance expense? You will tell them 300. Has it not increased from 0 to 300 because you paid? Do you get that logic? Sorry, come again.
Sir, I didn't hear what you said. Please, can you repeat it?
Okay, so I'm saying that if you pay insurance on your motor vehicle or your car, right? So let's say that in the first year you haven't paid anything, so it's 0. And then in the second year you went to pay 300,000 or 300 Ghana cedis. Would you not logically say that, oh, my motor insurance expense has increased from 0 to 300 Ghana?
Service, I don't understand.
Okay, you were paying light bill 20 cedis, right? If you go and pay additional 30 Ghana, what is your new bill?
70 Ghana.
So has your bill increased or decreased?
It has increased.
Exactly. So anytime you pay expenses, the expenses increase. But I'm saying that with regards to the accounting equation, you cannot say that expenses increase because expenses is not shown in the accounting equation. In the accounting equation is asset, capital, and liabilities. So you have to look at the effect expenses have on capital. So when you pay expenses, the expense itself increases, but it decreases capital. And I gave the real life experience of if your parent or if your mother, for example, is doing business and she's paying more expenses, the first complaint will be that my expenses are increasing. But the ultimate effect is that it is reducing her capital. Reduce. It is making her capital or her investment reduce. That is why when the expenses go up, the more she's paying for expenses, she'll later come back and say, hey, I'm not doing it again because all my money is gone. Do you get the understanding now? You see, I get where the confusion is coming from. People think that expenses are debt. So if you are paying for them, they should reduce. To say what the electricity bill cut into could tear electricity now, I was say so. But no. Let me see if I can give you another example for you to appreciate. When you pay electricity, say 100 cedis today, the next day 120, or let's say the next day you even paid 100. Or let me bring the figure down. So you paid 100 today. Tomorrow you pay 20, right? Cumulatively, your electricity bill is 120. It's no more 100 like you paid yesterday. Cumulatively is what? 120. So when you pay expenses, your expenses increase. But it decreases capital. I think, professors, can you hear me? Expense increase thing because I see majority of you are confused. Right. So I want to take my time. So ask all the questions that you need to ask. Or let's do a back and forth argument. Let's disagree to agree. So let's do it hand in hand, okay? So my point is that the fact that you pay expenses do not decrease the expense, or no. Because the more you are paying for the expense, the more your expense is going up. So let's say you buy a fresh DSTV decoder, okay? Please, can you hear me clearly?
Yes.
Yes. If you buy a DSTV decoder first month, you haven't paid anything, and somebody asks you, hey, so how much cost do you incur or are you paying for your DSTV? You tell the person, I haven't paid anything, it's zero. Now, when you subscribe for the first month and the person asks you, Let's say you paid for 120 for the first month subscription. If the person asks you, would you say that your DSTV subscription, the expense has reduced because you have paid? No, the expense is rather increasing. So the more you pay, the more it's becoming big. That's why if you are not careful, you pay, your expenses will be increasing, and your money will get finished. So here, your money is your capital. So the more you are paying for the costs, the more your capital is what decreasing. So as you pay, the expenses increase and they decrease your money, which is your capital. Now let me hear your side so that we can shape in and straighten and get to the right. So Nicole, are you okay now? And I think Agbeko was also expressing.
Sir, please, I'm a little bit okay.
Really?
Yes.
Okay, Joris. Yeah.
So in this case, expenses increase when paid.
Yes. When you pay expenses, they increase, but they decrease capital. So if you are showing the effect on the accounting equation, you don't talk about the expense, you only talk about the capital. So you would say that there is a decrease in capital, but you put into bracket expense. Okay, you get the point now, right?
Yes, sir.
So please don't ever think that when you pay expenses, they decrease or no. You see, you are seeing the decreasing on the part that you haven't paid for the expense. So you owe. As you pay, now your debt reduces, but your expense increase. Okay.
Sir, so what
Yeah.
about if you don't pay your expenses?
So you see, there's a thin line between incurring
Does it
expenses.
automatically decrease or
So there's a thin line between incurring expenses and paying them, but they are different. So you might incur an expense and not necessarily pay. For example, you go for somebody's building for 1 year, that you are going to stay in there for 1 year. Rent is 2,000. You haven't paid. But in as much as you start staying in the room and all necessary documents have been processed, we say that you have incurred the expense. Okay, so in accounting, you need to recognize that there's an expense. So incurring and paying, in terms of acknowledging the effect, right, they are virtually the same. Okay. Because if you incur, definitely you have to pay, right? So with regards to the effect, anytime expenses come into the picture, whether you have paid it or not, it is increasing, and in effect, it will decrease your capital. That's the best way I can make it sound meaningful to your ears. So let me give you this other perspective. Let's say rent, right? So you see rent, if you don't pay, right, or if you are owing, you say that, oh, your rent is 1,000 this year. Next year, another 1,000 Abeka, so it's increasing. But what if you paid 1,000 this year? Next year you are paying 1,000. It's not the same thing. Your rent is increasing. The item rent is increasing because you pay 1,000, you have paid another 1,000, so 2,000. You owe 1,000, you owe another 1,000. It's the same 2,000, right? I know that expense and income thing can be confusing, especially when you're analyzing on the face of, but hear from me that anytime you incur and pay expenses, they increase and they decrease your capital. And the other effect is they also decrease your asset because you are making payment. So they decrease your asset, they decrease your capital. Okay. The opposite is for the income, right? So for the income, So if it is true that when you pay expenses, they decrease, then the same when you receive income, they should decrease, isn't it? Because you are receiving income. But when you receive income, your income increases your capital, right? So you would credit capital, and it's also going to increase your asset. So if you are comparing income and expense, look at it this way. Income increases asset and also increases capital. But expenses decrease asset and they also decrease capital. Okay. So we are now on the return outwards, return inwards, and I think we can make progress after that. Today I'll try to give you some 6 or 10, transactions to do the analysis for me. Please don't put it in AI. AI will give you some lot of, non-meaningful points for you to give me. I don't like it. Okay, so return outwards. What is return outwards? Who is doing the reading for me? Let me see if I can get Prof. Joel Mensah. Joel Mensah. Can you do the reading for us? Return outwards.
Okay. Return outwards, also known as purchases return, refers to the amount of goods returned to the supplier or creditor by the business. It decreases an asset, that's stock of goods. Hence, a return outwards account is opened and credited, and it also decreases liability into bracket the creditor. So the creditor's account is debited.
Okay, thank you very much. I think that so. I think you appreciate this, right? Return outwards means you are returning the goods back to a creditor. Okay, somebody you bought goods from on credit. Let me see if I can demonstrate this so that we get it. So let's say that this is my business, okay, and Malcolm where Ghana shops is my supplier. So that's where I get my goods to sell as a business. So if I go for the goods and I don't pay, then Malcolm becomes what? A creditor in my books, right? So I'll have Malcolm's account as a creditor. And the other account to be what? Purchases. Because if I buy goods from Malcolm on credit, I would debit my purchases account. So let me use P. And then I'll credit Malcolm, the creditor, right? So if I return some of the goods, so let's put in figures. So maybe I bought 200 on credits. So this would have been I would have credited Malcolm 200 and debited my purchases was 200. So what it technically means is that I have goods 200, but Malcolm gave me those goods on credit 200, right? If I return back to Malcolm, my supplier or my creditor, let's say 50, then that is return outwards. Goods returned from the business to the creditor. So if I've returned 50 to creditor, do I still owe Malcolm 200? I need an answer.
No.
No. How much do I owe Malcolm now? 150, right? Because I've returned 50 back to Malcolm. So I need to show this in the account. So in Malcolm's account, I would come and debit Malcolm. And when I debit Malcolm, you see that it will reduce it. It will reduce how much I owed Malcolm. That's why we say that anytime there's return outwards, it decreases the liability, that's the creditor. It decreases liability creditor. And you can see that in the scenario here. I owed Malcolm 200, but because I returned some of the goods back to Malcolm, I now don't owe them 200. I owe them 150. How can I do that? I have to debit their account with what? 50. Now it means that this will also affect the stock, because I had stock of 200 and I've returned 50. So the stock should also what? Reduce. But here is it. You don't put it in the purchases account. So you open a return outwards account. Return outwards account. So you see, if we were putting it in purchases, we would have credited purchases 50, but we don't do that. We put it in what? Return outwards account, showing the decrease in the stock, the asset stock. So when there are return outwards, the two accounts are return outwards account and the creditors account. You debit the creditor because the liability creditor is decreasing, and you credit return outwards because an asset stock is decreasing. Now, interestingly, when you get to sole proprietorship, that is where we now less the trading account. That's where you now less the return outwards from what? The purchases to get the 150 true value of the goods you have. Okay, but we keep them separately. So if you have recognized or if you have realized, stock is having about 4 accounts. One is used to record when we sell the stock. One is used to record when we purchase the stock. One is used to record when we return some of the stock. And the other one will be used to record when our customers return the stock back to us. So stock is having how many? 4 accounts. Sales, purchases, return inwards, and return out. Okay. So I believe you appreciate this. The last one is return inwards, which is the opposite of what I've done here. Right? So return inwards this time means that we are not dealing with a creditor. We are dealing with a debtor. Okay. So the debtor would return the goods back to the business. Okay, so let's do this. Let me clean it. So if return outwards will reduce the stock, return inwards would what? Increase the stock or reinstate the stock. So it is going to increase an asset stock. So we open return inwards account. And if asset is increasing, we debit. So you debit returning. And then the debtor who is bringing back the goods, his balance is going to reduce. So let me demonstrate that as well so that you understand. Unless maybe you understand, then I'll skip it, but let me demonstrate for my purposes. So this time, we, the business, we have a customer or a debtor, right? A debtor, let's say Kofi. So this debtor is somebody who we have sold goods to. Okay, so let's say we sold goods of 250 to this debtor. He didn't pay. So in our books, when we make that sale, we'll open sales account and open what? The debtor Kofi. And then we open sales. And I believe now you all know when you sell goods on credit to Kofi, you will debit Kofi and you credit what? Sales. So we'll credit sales 250 and we'll debit Kofi 250. So look at the scenario. The scenario is that Kofi is returning some of the goods back to us, and that is called return inwards. So let's say Kofi returned 20 of the goods back to us. The simple interpretation is that Kofi will no more owe us what? 250. It has to reduce because he's returning goods to us. That's where we say the debtor, asset debtor will decrease. So we credit that account. If asset is decreasing, we credit 20. And so that when we credit 20, it will decrease the 250 to 230. Then we need to decrease our what? Our sales, because our sales cannot be 250 because the person has brought back what? 20. Okay. So when we sold, the stock decreased. Now the person is bringing it back. So the stock would what? Increase. And if stock is increasing, we open what? Return invoice account. We don't have to put it in the sales account. So we put it in the return invoice account and then we debit. Okay. Please, any questions? They may look so technical and so moodious, but please, if you sit down and you follow all the discussions that we haven't, you shouldn't have problems with recording business transactions at all. But don't worry, I think as and when we start solving questions, you see that, oh, at the end, because the transactions are repetitive. It's just the names and numbers that will change. Okay, great. So don't get scared, or don't run away from Omega accounting because you said, Mr. Mo is always saying debit, credit. I don't know whether this debit and credit, they are my friends or they are not my friends. Or that it mean the business I don't like. Oh, I want to go and do music. You think music is cheaper? Nothing is cheaper in this world. Everything is difficult. When you commit yourself to doing it, it becomes easier. Even eating is not, even sleeping is difficult. You know that. Somebody told me that, the only thing that is not difficult to do is when you are shopping or spending money. And I said, okay, you don't know. Spending money is even difficult. Or you disagree? Okay, so professors, the last one, I said 10, but I think we have a last one, 11. That's when the owner makes drawings or takes something from the business for personal use. Okay, and this happens with the sole proprietors. I am doing my own business. If I need something, can't I take it? Maybe I'm selling televisions and then my personal television is spoiled. Can't I take some of the television? But you see, in accounting, we account for this because if we are not careful, the owner will be taking things away from the business and will not be reporting or recording it. So anytime the owner takes something away from the business, we also acknowledge it. For personal use, we acknowledge it. And we call that drawings. So drawings refer to withdrawals made from the business by the proprietor or the owner for his or her personal, please, very important, personal use. Okay. So let's say you sell shoes and then you take some of the shoes for your child. That's a personal use. So it's drawings. Or your daughter is not working for the firm, then you pay her salary. That is drawings. But if your daughter is working for the business and you pay her salary, that one is normal. It's a normal business transaction. But if you are paying your daughter when she's not doing anything for the business, that's drawings. So what does it do? Drawings decrease the capital. Because you, the owner, you have invested money in doing a business. So if you are taking something away from the business, then your capital is reduced. Okay. So drawings decrease capital. But what account do we open? We open drawings account. And when capital decreases, what do? We debit. So when you open drawings, you debit. And the owner can take cash, can take money from the bank, or sometimes he can even take another asset. Okay. So whatever the owner would take would decrease. If he's taking cash, cash will decrease. And if cash is decreasing, what do? We credit. If the money was from the bank balance would decrease, so we credit. If he took a land, the value of the land would decrease, so we credit. Okay. So these are the 11 transactions, my professors, you need to take your time. That is why I would employ all of you to watch the videos. Where you didn't get the point well, please, after taking your bath, sit down. Tell your parents, please, I'm in a learning mood. No disturbance. No, hey, go and take this for me. Hey, no. Instruct your parent. Please, I'm learning. Please do it respectfully, otherwise they won't pay your school fees. So say, Daddy, today I beg you. If you send me, I will not go because I'm learning. How many of you can say that? Anyway, that's just by the way. But you can tell your parents to spare you some time because you are there. Okay, so you see, yesterday I told you about the two main requirements. They can either tell you to tell us the effect, or they will tell you to record in the account. So if they tell you about the effects, or they require that you talk about the effect, then you only do the increase in asset, decrease in asset. But if the name of the asset or liability is given, put it in brackets, right? And for expenses, so expenses decrease capital, then you put it in bracket rent expense, or maybe salary expense. Okay, so professors, I think I did a summary for all the transactions, okay, in here. And this is an example for us to look at. The following was related to Mr. Yangson Limited. So if you check the transaction, you see that they all reflect what we have discussed. Started business. So it means the owner is making investment. Bought goods on credit, okay. Contracted a loan, bought vehicle, cash purchases, pay Jackie 250, withdrew 100 cedis for private use, bought goods on credit. So you see that they are now making sense, right? Credit sales, cash sales, credit purchases, cash purchases. The business is buying an asset, the business is going for a loan. Okay, so I think I'll pause here. I'm going to send this question to you for you to try. All I need you to do is to show the effects and, if possible, prepare the T account, right? So I'll share it with you. But if you have any question, you can ask me so that maybe I go over a certain point or something. Yes, Prof. Nico.
Sir, please,
Sorry?
are we doing it in a tabular form?
Yeah, you can. Yes,
Okay.
you can do it in a tabular form, or you can present it in a way that, so somebody will not put it in a table. You just write the transaction, and under the transaction, you write increase in assets in bracket cash and decrease in liability in bracket creditor. It's accepted. But I think when you create a table, it makes it look well organized.
Okay, and the B.
The B is prepare a statement to show the effects. No, we haven't done that part. I think your new curriculum will not worry you on that one, so I'll not bother. You do you use the plus and minus to show the effect, because if you say an asset is increasing, then that is plus. If it's decreasing, minus. So you use the increasing, the plus minus, to be adding and subtracting to get a final figure. But this curriculum will not, bother you much about that. So, but maybe I'll show you a sample for you to appreciate what it is. Okay, Josh.
Before showing the effect, are you supposed to write the whole transaction all over, or just write the as in the 1, 5, 10?
Well, yes, you can use the date. Okay, the date given the transaction. If there are no dates, you can use the numbers. So maybe transaction 1, then you show the effect if you want to avoid repeating the transaction. But under exams condition, which would be best? Now, if you can write the transaction, why not? If you can write a transaction, because writing pay Jackie 250 cash will not take you. Even the longest of them contracted a loan 500 and open a bank account. You can put it there. Okay. Plenty fish does not spoil soup. Okay. Any other questions? So I'm really asking you to do this assignment because I want to see how well you appreciated opening the T account in school and you are doing debit and credit. So those who didn't do it in school, don't worry. Just try what you can do. Okay. Yes, Nico.
Sir, please, is the T account the same as a general ledger?
No. The general ledger is a book where you will see the T account, but the general ledger itself is not a T account. It's a book that keeps account. As a matter of fact, ledgers keeps account, and we have 5 ledgers. The general ledger is one of them. Okay. I think I spoke about it during the books of accounts.
Yes, this is it. So you're asking us to prepare the ledger. So
sorry, the ledger account. The ledger account. Don't let the ledger there confuse you. It's just the T account. You are not putting in any specific ledger. It's just the T account.
Okay.
Yes, you see, you see how babies learn to walk. See, when they start falling and then they fall down, then some. I don't want to share a story. My small daughter has been falling down left, right, center. But you see, when you fall down like that, and then you are learning. So I'm really testing your walking abilities. I want to see how some of you fall. Then when you now master it, we are good to go. So we'll solve this together. But I want to see how, go and sweat small. Mr. Amwa sweats assignments. Please, if you go and put it in AI, I will not say anything, but God is watching you. You know the thing you are putting in AI, and God is looking at your face. So are you not? Please, can we play that? Say, we will not put it in AI. Your silence means that you put it in AI, my boy. You go and put it in AI. No worries, I'll catch you. All those who do that, I'll catch them because AI has a way of presenting it. When I give my students a vacation assignment, they'll go and put it in AI and even forget to delete. Do you need more help? Ask me. They submit those things for me to mark. Like seriously. Okay. So, professors, I think I will end here. I'll take a shot of this question. Just try it. Okay, try it. If you can only do the increase in asset decreasing, that's fine. But if you can go ahead and do the TR, I would appreciate it. Thank you very much. I think your teacher, I have to find some small fufu and snake meats, python meats, and akrantie beanie soup. When I said python, somebody said, this is Chinese here. If you have chopped python soup before, you know that it's sweet. Anyway, I'm just kidding though. Don't mind. Okay, so profs, I'll see you next week, right? But next week, do prepare for your accounting test. All other things being equal. Have a blessed day and be very responsible and good professors. Bye-bye.
All right, sir. Thank you.
Okay. So I'll share the recording for your producer.